Okay, perfect. Well, let's get started. If we have any more stragglers coming in, we'll allow them in, I guess. My name is Danielle Wildfong. I am a farm risk management advisor with Maverick Ag. And I guess I met Tyler through CAFA and Byron through CAFA, and we wanted to do something for our clientele because we can't be in person, we can't be at conferences. So we thought, why don't we give some best practices and some tips kind of from what we're seeing from risk, insurance, legacy, estate, succession, and tax for the upcoming year. So it's kind of a new year, new plan. What's on the horizon for your farm? Depending on what stage you're in, I think you'll find some value from the presentations today. So I'm going to start off just by introducing Maverick Ag, because I think most of you are familiar with Buckburger Bird. Maverick Ag is a risk management company in Saskatoon. Our farms are our clientele. We do risk management. We have some CFO work that we do for some farms, and we are insurance brokerage as well. So how we're different. So we are risk management advisors, and we do review risks a little bit differently than probably most risk advisors. Our risk paradigm is 3 areas. We review financial risk, operational, and insurance. And our goal for the farm is to make you risk-free. So we're a lot of benchmarks, a lot of ratios, analysis. We talk a little bit about continuity and succession, but mostly identifying where the exposure is and building strategies for the farm to cover that. Now, our approach is really in our risk management planning. We want to understand your goals, analyze the farm's risk exposure, and then build a plan so that we can remove as much risk as possible. So we are a brokerage of global ag risk, and that product is really designed to protect your margin. So if we can get a strong gross margin and low fixed costs, we can make the farm bulletproof, right? And those are the hardest things to manage sometimes, is growing the grain. Can we market it at a good price? But can we keep our fixed costs low? So that's our biggest focus, is removing some of that uncertainty, some of those known risks and unknown risks, so we can build a plan to help you achieve your goals. And really, the goal of being risk-free is that at the end of the day, we don't want to be selling you insurance. We want you to become bulletproof enough that we can use that money better somewhere else. That's really the goal of a risk management plan. So why would you work with us? Because our core values are really centered around protecting your farm, growing it, and optimizing it with a good attitude and building collaborations with our clients and partners. Hence why we're doing this collaboration today. So today I want to talk about something a little bit different to what we usually delve into on the risk side, but a different type of risk. So we're going to talk about the risk of not communicating and not following through on our plan. We could have the best succession plan from the best accountants, the best lawyers, the best tax advice in the world, but that succession plan will fail if we don't have communication and planning around it. So my talk today is on 10 ways to save your legacy. And why it's important? It's because a legacy defines us and it drives everything that you do. And you probably don't think about it very much, but I'm going to kind of open your eyes a little bit to think about some different things in your family and in the business. So why is this important? Why did I choose this to present to you today? Because 70% of succession plans fail when there's a lack of communication, planning, and follow through. So I thought I'd give some tips and strategies that we've used with some of our family businesses to help them understand what it is they want and how to communicate that. So what's the greatest challenge that we come across when working with family business? So this is what families say they need. 80% of the time in a transition or succession, they need non-technical soft skills. They need communication. They need mediation. They need the general contractor, right? And the number one thing that families want from their advisors is they want us to communicate with each other. So when we do a continuity plan or a risk plan, or even just a risk strategy with a family, we have the accountant, the insurance, we have the lawyers there to discuss the shareholder agreement, and we have ourselves and the family as well. We need everyone in one room so we're all on the same page, so you don't have to do the work of trying to bring the lawyer up to speed from the accountant's point of view. So that's the greatest challenge. Now, when we talk about the family enterprise, there's kind of three different areas. There's the actual family within the enterprise, but a family enterprise is built up of values, beliefs, the family business itself, the operating business, and wealth. And that wealth is made up of the assets, which can be financial, which can be heirloom assets, life insurance, but it's also made up of the real estate and any charity or philanthropy. So all of this compromises your legacy, right? It's what you leave behind and what that legacy is to you. So what is legacy? So legacy is what people remember you by. It's not an estate plan. However, you can manage your legacy with an estate plan, and that's where it kind of gets blurry, right? But what it comes down to is the character, quality, and deeds. And for most of the families that we talk to, it is more important to them to pass down strong values than it is to pass down capital. And I think as you get older and as our farmers get more experienced and get older and reflect kind of back, they realize that they want to pass down a strong set of moral values as the moral compass, right? The capital is good too, but we also don't want to rob our children of their achievements. So, and I'll get to that. So where do we start? Number one. So the number one tip is really to define your legacy and what it means to you. Now, I've talked to 30-year-old farmers that are already thinking about their legacy because they have young children and they want them to be involved in the farm. But really, the first thing to do is to understand what's the foundation, why is it important, and what do you want, right? What do you want to see happen to the business or the family when you're no longer there? So the first thing we want to look at is clarifying the values. So how do we exemplify our values and priorities? We need to identify them. Then we prioritize them, and then we base our actions on those priorities, right? It's our moral compass. It's the operating principles that the farm business operates within. So an example that we use at our farm is 5% improvement, right? If you've ever seen Christian Hebert speak, he talks about the 5% rule from Danny Kleinfelter. And what he says is every year we try to get 5% better in all the areas of the farm, right? So our 5% improvement on the farm with integrity, communication, and follow through. And at the end of every quarter, we sit down and we look at how did we achieve the goal? And how well did we do it within our operating principles, within the values, right? And then we have to rate ourselves. And then the boss rates us. So we have a very open communication and open dialogue about how things are going, how we're running things, are we aligned, and are we achieving the goals that we've set out for ourselves? So values are not taught, they are caught. And I'll explain this because we can't teach values. We have to live our values and show them, right? You can't, and this isn't just with children, it can be with your team member as well, it can be with your partner. You don't always have to prove, you always have to prove you're a leader. You can't just tell them that you're in charge. So this really comes down to leading by example and living those values. So I'll give you an example of how the estate plan can reflect legacy, but how it can also quickly go wrong. So I work with a family, and it's a story about a farm family who worked together. There's a father and two siblings that worked in the farm, daughter and a son. So the daughter squandered opportunities, was deceitful, and she didn't live out the values of the farm. The son, on the other hand, behaved well. He was open, He was very grateful. He took on lots of risk, and he developed a lifestyle and values that the father respected himself. Right? He aligned with, I guess, the values of the business. So the inheritance, can you guess who he left the money to? So he left the money to the daughter because he felt bad for her and he thought that he could save her or help her. So in this case, the estate plan did not reflect the legacy or fairness. So it's just an example of where the estate plan can go wrong and how maybe if they communicated more, he would have rethought what the right thing to do was. Instead of giving it all to the daughter, maybe he'd split up differently between daughter and son. So another way to instill these values is to develop a mission statement. We have our mission statement on every wall in our company at Maverick, but you can develop your own personal mission statement, right? It's your chance to identify what's important and what you're doing with your time. You can add your attitudes and behaviors that you want to live by and those that you want to eliminate. So it's much easier to live the right way when we state what we want and kind of what we're looking to do. So number 2, involve the family. This is probably the first and foremost, most important question that we ask when we're working with farm families. And it's called the R factor question. It's a strategic coach. It's a coaching question, but we ask the family to put themselves in the future 3 years. And then we ask them what has to have happened for you to feel happy and satisfied with your personal and professional success. Then everyone in the family goes back, they work on it, they come up with what they think they need to achieve. And this can be 5 years, this can be 10 years, depending on where you're at in the stage. And then we come back to the table, we share the answer, and we look for commonalities, we look for alignment, and we listen for things that we didn't know before, right? So this also helps us identify dangers, risks, and what ifs. What if we have a non-farm sibling who wants to come back into the farm? It's a huge opportunity, but it's also a risk. Now we're divvying up what the farm's got to more family members, right? So we need to look at it from the pros, the cons, and how we can build a plan around that to make it all work and make it work well. So we identify dangers and risks, we look at the opportunities, and then we look at the strengths of each person within the operating business, right? Where are we best at, and where can we kind of delegate those managerial tasks to, and who's doing what, and what gaps do we need to fill? So I find this is one of my favorite questions because it also helps us identify what's keeping you up at night. And that's really, as advisors, what we want to focus on first. So knowing where we're going and knowing what we want, then we can set goals. And we can set goals for the farm, we can set goals for the family. It helps us set an aim. And if we can align our aims with the family, we'll have a better chance of achieving them. And let our advisors in on it as well. So this is something you can meet annually about. We meet annually with some of our farm clients, not only on their risk, but on the family business side as well. And then we look at the progress and see if maybe we need a reset, or if we need to kind of shift where the goals are at, or if something different's happened. What do we need to look at differently, and how can we adapt our plan and strategy around that? Number 4, even playing field. So with the farming children, it's really important for the successor to not identify favorites and no competition. It will more likely drive away a child or create resentment and self-doubt. So it's really important that you kind of recognize and appreciate the differences among the team at your farm. Right? And it doesn't have to always be about your children. Your legacy can be anyone around you that you're a role model to. So it's in recognizing opposites. And with the children, allow them to be themselves. Because if you appreciate and validate who they are, they're going to have a better chance at actually building that confidence and being okay with who they are, right? If we don't allow them to kind of live by their own standards and we're too rigid within principles, it's likely to push them away from the farm. And this is something I think in talking with older farmers that really, really want their son to take over, right? And the son doesn't really want to take over. I think there's a lot of pressure there. There's a lot of pressure, and it maybe didn't give them the freedom to explore what they wanted to do and then end up at the farm. So something to keep in mind. Number 6, encouraging diversity of thought. So I think this is a really big one, is ask yourself, and it's a self-awareness piece as well. But are you promoting a challenge or are you promoting the status quo? There's a really excellent speaker and trainer. His name is Jocko Willink, and he's got a book called Dichotomy of Leadership. And what I like about him is he talks about the war and leading his men at tours in the war. And he says, we do not want yes men. Because if we have a group and it's all group think, that's going to be more dangerous if they're not thinking curiously about things and challenging what we're doing all the time so that we're not making a mistake and going in blind. So think about that on your farm. I find some of the best examples of that would be non-farming employees or someone that's very green to agriculture. When they come into a farm, they're so curious and they ask so many questions. And we find we learn more from them than we do sometimes just going along how we've always done things. So question your leadership, right? And respectfully, but it's your job to define that vision, but not all the time can you see everything, but a collective team can. Number 7, be vulnerable. So this is where you want to talk about personal relationships, fears, any concerns, and feelings, right? If we can't be vulnerable and communicate, we have a breakdown of communication, and a breakdown of communication is also a breakdown of trust. If you need a resource and you're curious about this, I would look at Brene Brown, and she has a talk on Daring Greatly. And she talks about courage and vulnerability, right? Because we can't actually communicate about what we want or what's bothering us or set clear boundaries, then we really start to have nothing to talk about but the farm, when maybe we're missing a really important piece. And sometimes we don't figure that out until it's too late. So I don't want that to happen. So start to think about how you can talk about how things are going. How's it going? Are you happy here? Is everything working out? Do we need to change anything? It's as simple as just asking the question, how are you doing? How can we make things better? Oh, it's one of the best strategies to keep some of your top employees is making sure they have a fit, they feel respected, and they feel like a part of the team. 8, ask your family what they want. And if you can't do that, then hire an advisor to help you, because there is a lot of pressure on the farm to be like your mom or your dad. Right? Make sure everybody takes the time to figure out what they want and communicates that. So I think a lot of times we don't say what we want or we don't do what we want because we think there's an expectation of us. And then we end up living in this resentment. And it's not that we resent dad because he wants us to be a farmer. We're generally resenting ourselves for not having that courage, that vulnerability to open up and say, hey, maybe I want to try something off the farm. Or maybe I want to try something a little bit differently on the farm. Can you talk about that? And if you can't, then maybe it's time to look at some additional resources. Also, a really important piece is to make sure it's on the table that everyone knows what they want. Do the siblings want to be tied together financially or legally? So just because they get along now does not mean they will get along in the future. So something to keep in mind when you're looking at shareholders agreements, wills, anything that will tie two people together that should be discussed. Because the worst thing to happen is after say the farmer passes away, the kids weren't clear on what was going to happen, and they will resent each other because there's no one left to resent. So number 9 on saving your legacy is to write it down. So when there's nothing that's been communicated, there's nothing worse than there's nothing worse than having your own imagination, right? Because you're going to start making up stories. So I worked with a family business, and the father had passed away, and in the will, he had left the farm to one of the children, the non-farming sibling, who was a doctor, and not to the ones that were managing the farm. So you could imagine what happened after that was announced. They tore that office apart looking for any idea of why. Why did he do that, right? So I think you don't want to put your children or your partner in that situation. So write it down, talk about it, get a shareholders agreement, right? Because a will can change with one signature. So we don't want that to happen. And the last one is share it. Share your thoughts, however you need to do that. Maybe you just put it in writing because you're not at that stage of communication yet. It's a good start. So share it, revisit it, and evaluate it. I think would be my advice on saving your legacy and protecting the continuity of your business. So I don't know if there's any questions. I might switch over to the next presentation. But if you do,
nothing in the chat right now.
Okay, perfect. So this is my website. That's my number. You can call me anytime. I really appreciate that you guys came out to spend some time with us. And yeah, I think I'll pass it over to Byron.
Thanks, Danielle. So we will circulate the material from today. And so you will have the handouts, and we will also share the video link as well. So I'm just going to share my screen. Just 1 second.
Yeah.
Okay, can everybody see that?
Yeah.
Okay, perfect. So we must have been on the same page, Danielle. We came up with a top 10 list of our own, basically kind of polling our top 10 common client issues that we're seeing with our ag clients right now, the top 10 issues that we're seeing. And so we're looking at this from a succession planning and tax restructuring point of view. So and maybe just to start, my name's Tyler Kachur. I'm a partner here at Buchberger Berg. And also I know Danielle through being on the executive of CAFA, which is the Canadian Association of Farm Advisors, which is a great organization just in terms of connecting advisors across Canada who are all kind of dealing in the same ag space and dealing with very similar issues. And I'll turn it over to Byron here.
Yeah, my name is Byron Bitz. I work at Buchberger Berg here. I'm a CPA, specializing in tax. I'm a farmer as well. I farm just east of here at Allen, Saskatchewan, as a first-generation farmer with my uncle, and live and reside in Saskatoon. So,
perfect. So maybe just before we get going here, for those that are unfamiliar with Buchberger Berg, I guess, who are we? We're a local firm that was established in 2014, founded by 8 partners who all came from the University of Saskatchewan with local roots, wanting to serve locally and provide great client service. We employ, so we started with 8, and we have approximately 75 members of the organization at Buchberger Berg, where we have a focus on ag. We have an ag team that focuses, I'd say approximately 25% of our clients are agriculture clients. And we have a dedicated team that services our ag clients. And so, you know, we thought we'd share this picture because a lot of our clients deal with different members of our group, but they don't actually, they've maybe never met them. And so we'll just run through this. We've got from left to right, we've got Patty Lang, who Patty is from Rosetown and deals with a lot of clients out the Rosetown way. We have Haley. Haley does a lot of our bookkeeping, so a lot of you would be familiar with Haley. Jordan Anholt is a CPA manager with our firm. We have Ashley Buchberger, who's a partner who deals a lot in our review engagements. We have Byron, who just introduced himself. We have Levi Dirksen from Rostern, Saskatchewan. myself, Robin Baker from Radisson, and Janet Bueller from Aberdeen. So we actually have quite a cross-section of, I guess, talent and where everybody's from. So we're serving all across Saskatchewan.
So yeah, there's our mugs again, in case you didn't get enough the first time. I think to expand on what Tyler was saying, everyone in that picture has a different role in what they do. Tyler and myself more on the tax side, and then we have the bookkeeping side and assurance side, but we use our skill sets and a team approach to give clients the best service. I mean, we can't be an expert in every area, so we focus on our areas of interest and our areas of expertise to help provide you guys the best service possible, and that involves multiple touch points. A large part of that group has a farm mentality. They either come from a farm or somehow involved with a farm, either through marriage or whatever. So there's a lot of farm knowledge there outside of our expertise with accounting or tax, just on how the business works and what some of the lingo is. So we use a collaborative approach to provide really good service. And again, our service lines really involve advisory. So just, common kind of conversations on what a client is doing in the future, what their future plans are, and then advising and making sure that all fits with the succession of the tax plan. Tax planning, Tyler and I, that's where we fit in, and that's our area of interest. Ag invest and ag stability, so those agri programs are important risk management tools. The compliance stuff, you have to file tax returns every year, so that's part and parcel of the service package, as well as the financial statements and analysis.
And so, in terms of, a lot of people think accountants and they think, it's just compliance, it's just preparing the financial statements and the tax returns. But the way Byron and I approach this, and our firm in general, is we're more than just compliance, we're planning. And we want to know kind of the goals and objectives of your operation. We need to know that, because the planning that comes with being kind of your trusted advisor, the planning is very much tied to those objectives and long-term goals. So I've got a list of 6 things that, just came to mind. You've got clients that come in and say, well, I've got 5 crops left. Well, that kind of provides you with a time frame as to we better, we need to maybe expedite the plan if that's where we're at. I've got a farming child. Let's talk about succession. And Danielle did a great job in her top 10, kind of dealing with that legacy component, but even, assessing the children. You've got the non-farm children. There's this fair concept. Are we looking after the non-farming children as well? Retirement, what's going to happen if we do not have a successor? Are we going to sell the land, or are we going to rent the land? What's the size of your farm and the profitability of your farm? That all plays into the tax planning, and we have goals of expanding. So all of those discussions that kind of happen along the way really help shape the tax advice and the plan. And so, yeah, like I said, we came up with kind of the top 10 most common issues that are facing our ag clients, and we thought this would be of interest to our viewers today. And so what I've done, we've kind of queued up the real life examples. We have not used real life names, so don't worry if you see your name on there. But what we'll do is we'll present the issue, and then we'll have kind of a discussion about what we need to consider and deal with, and how we can remedy the situation. So number 10, this is a David Letterman list here, countdown. We've got number 10. We've got excessive non-farm assets accumulating in FarmCo. So during our year-end meeting, we discussed that the farm has had some great years and net income has been really strong. And we noticed that we have a new investment account on the balance sheet representing about 20% of the fair market value of the assets. And in that same discussion, we've determined that we've got a farming son that has his own farming company and is eventually going to inherit mom and dad's assets. So, one of the first things that come to mind here is, we have a 90% test that we need to consider when dealing with rollovers. I'm going to let Byron speak to the rollover rule in terms of transferring shares to a farming child.
Yeah, so I mean, farmers here, and this is a real head scratcher sometimes. I mean, as farmers, we get this unique treatment where we can pass land, or we can pass shares of a farm company down to the next generation without tax, provided we just follow a simple set of rules. One being that 90% of the assets inside a farm company are active in the farming business. So if you have an investment portfolio or you have too much cash in there, that throws you offside these rules. So when you pass, you have a deemed disposition of all the assets, and your shares of that company would be one of those assets. If you don't meet this test, that disposition happens at fair market value and you have a big tax liability. So this is quite a common issue, I would say, that we see where perhaps unbeknownst to the shareholder, they're offside this rule and they're walking around with a huge tax liability because the values of land have exploded here over the last decade, and the value of the company has grown quite significant, and they're offside this rule. So provided we follow these rules, we can pass those shares on to children without tax, either living or at death. In this particular scenario, we may look at some of those non-farming related assets, look over at our son's company. He's just getting started. Maybe we want to spin some of that cash over, help give him a head start. By doing that, we purify our own company so that we're onside the rules, and we've kind of kept that cash in the farm business, use it to grow our operation, and now we're back on side and we don't have a big tax liability.
And I mean, where this really comes into play is, especially if one of the mom and dad, if they're widowed, because then if there's a death of the second person, that's when they're going to trigger that capital gain. So while both are living, it's still problematic in the event that there's an accident, which obviously we have to consider worst case scenarios. But if there was an accident involving both mom and dad and we hadn't done the proper planning, we've got a big capital gain when we could have otherwise transferred that tax-free to a child.
Yeah, this is one of those ones we typically, even though there may be two people living, there could be a car accident tomorrow and both are gone, right? Like if we're walking around with this sort of tax liability, we try and fix it immediately because death obviously is uncertain and we don't know when it's going to come. So,
and if that cash isn't intended to stay in the farm operation or go to a farming company, like a son's farming company to help him expand, if that's truly your cash, we can consider the holding company option as well to kind of segregate that cash into your own holding company so that your shares of FarmCo are pure. So that's number 10. Issue number 9, qualified farm property. And we have a slide next which kind of explains what that is, but just think of that as land for now. Qualified farm property is not owned personally. So we're reviewing the land holdings of our client, Steve, and he advises that all land is owned in the company. We confirm that Steve has in fact purchased all of the land by way of historic profits of the company, and Steve has never used his lifetime capital gains exemption. What do you see wrong with this scenario, Byron?
Yeah, so it's highly unlikely that someone's going to come along and buy the shares of Steve's farm company with all the inventory and equipment and all that stuff in there. I mean, really what they're probably most interested in is the land. So in this scenario, if Steve's thinking, well, there's probably some neighbors out here that they'd be willing to buy my land, but probably not anything else. So what we can do is we can take that land, spin it over to a new company. So we basically have a land company. And if we have an arm's length buyer come along, they can buy the shares of that company. Steve can claim the capital gains exemption. And actually the purchaser can wind the company up and get a bump on his land. So he's actually indifferent. He's getting a high cost base on the asset. Steve's getting his gains exemption, and it kind of works for everyone. In a scenario where Steve says, well, I'm probably never going to sell out, but I really have no way to use my capital gains exemption, perhaps in that scenario, and we'll talk about this a bit more on the next slide, is drop everything down to a partnership. A partnership interest will qualify for the capital gains exemption, and we can generate that internally as long as we meet a couple of tests, one being the 2-year hold period test that we have the partnership for. But there's a lot of different ways we can slice this up so we can actually turn that capital gains exemption into cash. That's the biggest thing. We don't really want to crystallize anything. That's kind of a waste of time. It's nice to get the cash out of it at the end of the day.
Great. Yeah, I know this is a common scenario where we do see that, where clients have not used their gains exemption, but they're not set up to use it to monetize that capital gains exemption and get cash in their pockets. And so Byron's just gone through a few examples of things we can do to set you up so that, if that offer comes in that you can't refuse, you're set up to potentially sell some lands that's in a land co and use your capital gains exemption to offset some of that capital gain.
So again, like we were just talking about, every individual has a $1 million capital gains exemption on qualified farm or fishing property. And qualified farm property would include farmland, so land that's been farmed by, either yourself or your parents actively. Less commonly nowadays is quota is another option. And then, of course, as we just talked about, the shares of a family farm corporation, and what that definition is quite expansive, but basically we could sell the shares of our farm company and claim the capital gains exemption. Should that not be possible, which is, like we talked about, unlikely, then we can look at something like a partnership, dropping all the corporate assets down into a partnership and have individual partners, and eventually those interests will qualify for the capital gains exemption. So we can use that tax tool to our benefit. And at least, we can speculate maybe what's going to happen in the future, but it certainly seems that tax rates probably aren't going down. So it's nice to do this planning while we know what the game is and we can execute on it before anything changes.
Number 8, we've got wills and ownership of assets are inconsistent. And so we will see this quite often where, I guess I'll run through the scenario. We're reviewing the last will and testament of Brent and realize that he wants to will 2/4 of farmland to each of his daughters. Upon further review of the financial statements, we confirm that the 4/4 that he wants to will to his daughters are actually all tied up in his farm company. And the shares of FarmCo are being gifted to his son. And so this creates a real mess because, what dad wanted, what mom and dad wanted was a fair distribution of assets where we've kind of earmarked 2/4 of land going to each of the daughters. The problem is you can't will what you don't own upon death. And if you don't own that land personally, you can't will it. And so what he owns personally is the shares of FarmCo, and that's going to go to son.
Yeah.
So a real issue here.
That's a big problem. Yeah. And a common one. We see that enough where the will really doesn't jive with, maybe there's been some restructuring or some assets moved around and the will was never updated. So I think we really do, do a good job of encouraging people after these restructurings to update their will to reflect what's just happened so that everything kind of jives and is current.
Yeah. And obviously we've got an ability, if we catch this in advance of Brent passing away, to fix the problem. While Brent controls everything, we can spin that land out into separate land companies for each of the daughters. And so what would happen in that scenario is then we just advise Brent that it's time to update your will. You're giving FarmCo to your son, but you're giving a land co to each of the daughters. And maybe you establish a long-term lease agreement in advance of that so that son's got the ability to farm that land for as many years as he's farming.
Yeah.
So number 7, legal and beneficial ownership of land is inconsistent. So Amy is looking to sell 4/4 of land for $250,000 a quarter and use her capital gains exemption. She pulls the land titles and she is shown as legal owner of the 4/4. But upon further review of the financial statements, we confirm that 2/4 were sold into the company for shareholder loan in 1997 for $100,000 a quarter. It appears that in order to save land transfer fees in 97, that legal title was unchanged, but the beneficial ownership was sold to the company. So maybe first let's talk about legal versus beneficial ownership.
Yeah, so I think a lot of times we really don't want to pay the land transfer fees if we're maybe selling a personally held quarter of land into the company. It's just an extra cost that maybe we don't want to incur at the time. The problem is you get into this type of scenario, which we see enough, where 10, 20 years later, we're kind of looking, scratching our heads saying, where is this stuff? I mean, on the RM map, it's personally, but is that actually the case? So you can get into a bit of a mess. So it is nice, I think, when titles jive with who beneficially owns the property. But I guess I'd put my hand up and say I don't always do that, being that sometimes there's pretty significant land transfer fees that come along with actually making that happen. So if that's the case and we want to avoid the land transfer fees, just documenting properly, you know, in the will or in the file, just to make sure it's clear that that land has been transferred into the company. It's beneficially owned by the company, even though legally it's still personal.
And obviously, if there's a contentious issue on the horizon, we want to make darn sure that matches up, because we don't want title still to be in dad's name, even though you've got the beneficial ownership of that land, and you've got siblings that are challenging the will, you know, or the estate, saying, well, no, that sure looks like dad's land, and it's up to you to prove that. So best practice, have them jiving. But in this scenario, from a tax point of view, Amy thought she'd be able to shelter most of that capital gain with her gains exemption. And in fact, it turns out that, you know, we've got a $400,000 capital gain in the company, which was never the intention. And so, but that's what the result is. So number 6, a reluctance on transferring assets to the next generation. And we'll see this quite often where we've got, so the scenarios, we've got John, who's 80 years old and personally owns 12 quarters of farmland, which is being farmed by his son, Jimmy. John reports crop share income of $100,000 per year and loses his old age security every year because his income's too high. Jimmy's eager to purchase this land at the family rate, but John's worried that what this will do to the cash flow. So do you want to speak to kind of the issues surrounding this one?
Yeah, so I mean, basically, here's another instance where potentially we can use a capital gains reserve to you know, if John's going to end up selling some land in this case. Yeah. So farmers, again, like everyone else, if you're going to use a capital gains reserve, everyone else gets 5 years. Farmers, we get this special treatment where we get double that. We get 10 years to bring that capital gain into income. So in this case, where John is of an advanced age and he's collecting his OAS, to the extent his income goes over 78,000 thereabouts, he's going to start to have that OAS clawed back. So if he can stagger that gain using a reserve and bring a little bit into income over 10 years, he keeps his OAS purified and doesn't lose any of that. And then they're still accomplishing the economics of the deal.
And I think the reason, and I've got it as a bullet point right at the bottom, but I think a lot of the hesitance on transferring some of these assets, even though we know where they're going to go, is potential marital issues and marital concerns. You know, and the longer you keep an asset, obviously you keep it out of harm's way in terms of an eventual divorce, but there's the other side of it too, where you've just got too many personal assets that are, you know, generating too much income that, you know, it is hurting you from your old age security standpoint. And there's a better way to structure it where you can keep your cash flow the same, but reduce your income. And that's, I think, ultimately what we want to get to in this scenario.
Yeah, for sure.
Number 5, Farmco is getting too big. And when we say too big, we say based on taxable capital, which is when you look at your balance sheet, it's your liabilities plus your equity in general terms. So we're at another year-end review meeting discussing with our clients that their taxable capital is near 10 million, which is kind of where we start to get into trouble. And without any planning, we will start to see a reduction of our small business limit in future years as the taxable capital continues to increase. Daughter's farmed full-time with mom and dad for 15 years, but has no share ownership. What should we be considering in this scenario?
Yeah, so this is a big thing in the farm context. Like 10 million, I think when these rules came into being, it was a pretty big number, but nowadays, we see often a lot of clients that are either encroaching or have gone right past the limit. So what happens is once you hit 10 million of taxable capital, and really what that is in simple terms is your liabilities plus your retained earnings. But once you cross over 10 million, you start to lose your entitlement to the small business deduction. So you're seeing your tax rate go from what is now 9% to 27%. And that's a big loss of a tax deferral once you start to lose your entitlement to the small business deduction. So what we'd look to do is maybe move some assets out, or maybe daughter co has a new company that's not associated with the current company. That would mean there's no cross ownership, and we can get her some assets, get her some small business deduction, possibly move some capital over to her company to bring our number down so we're not so close to 10 million. Joint venture structures work here, partnership works here as well, to at least buy some time to get under that capital number. If the farm keeps growing, I mean, eventually you're going to hit it and maybe you have to deal with it. But I think there is some solutions we can have to mitigate that issue as it becomes one.
And the real kicker here would be if you've kind of been snowballing as well. So you've kind of been pushing forward a lot of your income with the hopes of kind of dealing with it in the future, not realizing that, you know, because of this rule, and there's another rule that we'll just speak about real briefly, which is if you have too much passive income, which would include farm rent income from an unrelated party, you know, between 50 and 150,000 of passive income is going to start grinding your small business deduction as well. So I'm kind of foreshadowing into number one here, but that becomes even more problematic when you start losing your small business deduction, but you haven't been using it in past years.
Yeah, exactly.
Issue number 4, we've got a shareholder loan problem. So this one's quite common. Based on a review of the financial statements, it's determined that Marvin has withdrawn more funds from the corporation than he anticipated declaring as personal dividend income. Upon further discussion, we determined that Marvin purchased some highly leveraged personal lands, and the debt payments are forcing him to extract additional funds from the corporation. And so this is the opposite problem of kind of the corporate land where we use the funds of the company to buy the land. This is the opposite problem in that Marvin's saying, hey, I want some land in my personal name to use the gains exemption. The problem is with the high amount of debt payments, it's forcing me to pull more money out of the company. So you want to speak to that?
Yeah, I think generally, you know, and I'd be the first to say that if all else is equal and you have personal land, you're better off to leave it personally. Once you put it inside the company, it really is locked in there and you're a lot less flexible with what you can do with your own estate planning and the rollover rules and so on. But in this case, and often is the case that it really isn't all equal. In this case, we're dealing with land that's newly purchased and highly leveraged. So what we're trying to do is pay off this personal debt by drawing out a bunch of money corporately, which obviously is going to give us a bunch of personal tax. So in this case, it would probably make sense to put that land in the company and pay it off at the low corporate rate of 9%, as opposed to our marginal rate of 30 to 40 to 50%. So anytime we can use leveraged assets, use the low corporate rate, that's what it's for. It's for reinvesting in your business, paying down your debt, growing your business. So I think that would be our recommendation in this scenario.
And the other thing to consider as well is the capital gains inclusion rates is currently at 50%. And, you know, there have been hints that probably not in this budget, but in the next, we could see an increase in that capital gains inclusion rate to 75% of your capital gain will be taxable. So that would be punitive, especially if they don't adjust the capital gains exemption higher than $1 million.
Yeah.
So if you are considering a transaction like this, probably best to do it within the next year.
Yeah, we're kind of speculating a little bit. None of us have a crystal ball, but given what's happened in the last year and the amount of money that's been spent, I think it's fair to assume that tax rates are going to increase, and some of this, you know, whether it's the inclusion rate or whatever, is going to increase. So,
good point. Number 3, share ownership does not align with economic goals of the farm. And so this is a situation where we've got Peter, who's the father, who's disabled, and we have son Luke, who's been farming basically 100% for the last 5 years. And upon review of the share structure, it shows that Luke owns these voting non-participating shares, and Peter still owns all of the growth shares. So upon further discussion, both parties agreed that they thought Luke owned participating common shares and that this is an error. Peter has sufficient off-farm assets to fund retirement. So this is just a scenario which is, we can fix it, but it's an issue that if you don't pick up on this during your financial statement review or during your annual check-in, that, you know, these issues compound. And so, you know, do you want to speak to?
Yeah, I think, you know, again, Tyler's right. It's easily fixed, but it can be a problem down the line, you know, potentially maybe how the will is, or whether Peter passes, you know, like how that's all set up. So if Luke's been farming, he really probably should be a shareholder. We can fix that issue with the farm rollover rules, like we said before. If this happened in another business, you'd have an even bigger problem because it's not as easily fixable. But we can gift those shares provided we're a qualified farm company, and fix the problem, and make Luke whole on his last 5 years of sweat equity.
The problem is if Peter passes away and his will says these shares are being split evenly amongst my 3 kids, and Luke's been farming thinking that he's had this growth accumulating in his name, we've got an issue.
Yeah, big mess.
Number 2, getting down to the wire here, marital issues. This one is becoming far too common. I don't know if COVID has impact on this with everybody working at home together, but we've seen more and more of this. And, you know, I hinted at this in terms of being an issue, why parents hold on to assets longer, you know, even though they know where they're eventually going to go. But in this scenario, mom and dad have farmed Farmco for many years. They're ready to transition the farming operation to son, but obviously want to protect what they've built. They don't want to exclude the daughter-in-law, but they're cautious. Byron and I aren't lawyers here, you know, but there are some general concepts we thought we'd reinforce with our audience.
Yeah, and I think, you know, like, we get it. Like, you know, generation or 3-4 generations have went to build the farm. The last thing people want to do is to see that halved or halved again by some sort of marital breakdown. So I get why people hang on to things probably longer than they ought to. But the issue is this can all be dealt with, you know, with a lawyer to deal with either a prenup or a postnup, a good unanimous shareholders agreement to deal with these issues, so that you can have the transition happen, still be protected as much as you can, and accomplish all your goals without kind of holding on to the bitter end and then passing, and then maybe you have a big mess anyways. So it's these are very touchy issues. Again, we're not lawyers, don't pretend to be, but we see them often enough and deal with them often enough where there are solutions, I guess.
And just in general terms, if you do gift something to a child, that gift is going to fall outside of marital property when they're doing a split in the event of a divorce. So if there are shares that are gifted just to son, or land that's gifted just to son, that asset should stay with son. It's the future growth derived off of those assets that end up getting split 50-50. So yeah, I think we'll leave that issue there. It's a loaded issue.
Could be a COVID issue, you're right.
Could be a COVID issue. So we're down to number 1. The number 1 issue that we see would be this snowballing concept and not taking advantage of the small business deduction. So we've got a new client meeting with Joe and his corporation. Joe discusses how they've been really profitable, but haven't paid corporate taxes in 10 years. We just keep deferring and pre-buying under the cash method, which is unique to farming, of course. Upon review of their balance sheet, they have $2 million of untaxed inventory, $1 million of prepaid inputs for next year that will eventually be taxed, and equipment worth $2 million. Joe plans to farm for 5 more years and has a son who might be interested in farming, but you know, we're not sure yet. If son doesn't farm, we'll likely just sell everything and have an auction sale. What do you see wrong with this scenario? Well,
This is one of those common enough, I'd say, but you know, farmers have the ability to always buy themselves out of a tax problem if they want to. I think the advice we would provide is that 9%, you're better off to pay a little bit going along than have this snowball, we call it, where you're basically deferring, and this snowball is growing and growing and growing. And then you're done farming and all this stuff, all this inventory, prepaids and equipment dispositions hits your tax return over 1 or 2 years. You got a big problem. You've left a lot of things on the table. at the end of it. Whereas if you would have just kind of paid a little bit of tax at 9% along the way, you wouldn't be dealing with this big deferred problem, and you'd be able to structure your exit, should you choose to exit, in a lot more efficient manner. So I think that is generally our advice, is at 9%, that's cheap tax. Pay a little bit along the way. Don't get into the deferred game. That's what a company's for. You get the preferential rate, so use it. Because once you go over 500,000 of taxable income, you go from 9 to 27, and that's a pretty hefty jump.
So that 9% is gold. Some of my best clients make great net income and pay as much of that 9% tax rate as possible, and even look towards avenues of multiplying the small business deduction. How can we get more of that? As opposed to, clients that, make a lot, but are just pushing it all forward. And it even, even if son decides that he is going to farm, is it fair to just push that issue onto son into the future? That's debatable. That's not technically son's liability. It's technically mom and dad's that they've kind of created and pushed forward. And there are issues and problems with pushing that into, son's got to manage his way out of that, basically. So definitely some considerations in this scenario here.
Yeah. And I think, like you talk about at the bottom, multiplying the small business deduction, looking at a cost share or a joint venture arrangement to maybe potentially in a good year, 500,000 probably isn't going to be enough. We don't want to get behind the 8 ball like these people did. So, and maybe we have kids that are involved. So if those fact patterns kind of jive, perhaps multiple companies make sense where you can get access to multiple small business deductions, multiple $500,000 limits, and thereby use more of that cheap tax.
I think this is kind of our last slide. If you want to,
we've kind of touched on a lot of this already, but really, the province of Saskatchewan, October announced that they're going to drop their provincial portion. So the combined federal and provincial used to be 11%, being 2 of that was provincial. And the province came out and said for 2 years, basically till July 1, 2023, we're going to drop the rate from 2 to 0, which gives us our 9%, which is all federal now, no provincial. Which just gives us an increased tax deferral, allowing us to pay cheaper tax, reinvest in our business, and grow it faster.
And so if you have fallen behind, 2021 is probably a good year to catch up at 9%.
Yeah, now's the time.
We've kind of talked about some of these tools in the tax tickle trunk, so we will leave that be. But that's our presentation. So thanks everyone for joining. All right, thank you very much.